Welcome. You're viewing the video version of the Pirls Stock Market Commentary, featuring the proprietary bull bear point and figure market breadth summary chart for May 8th, 2016. And happy Mother's Day to all the mothers who may be viewing this video. Market breadth. With this past week's market fractional decline, our bull-bear point and figure ratio at 1.07 fell from 1.60 last week, barely remaining within bullish territory. The total count of securities in bullish or bearish patterns decreased 5% to 3,030. The count of bearish stocks increased 20%, while the count of stocks in bullish patterns decreased 20%. The Pirls PNF Market Breadth Summary Chart shows us a market now 9 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary free of charge via email, simply enter your email address in the space provided. The well-known market breadth summary chart, the Nasdaq McClellan Summation Index, fell 211 points for the second decline in 12 weeks. At a positive 304.63 points, it has fallen back below the January 2014 and March 2014 tops, and continues above the 3 remaining tops within the last 3 years. And it continues above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither distribution nor accumulation mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 0 accumulation days and 5 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum, now at minus 136.60. The CCI 20 daily rose from minus 199.04 last week, is outside the plus or minus 50 range for a valid zero-line reject long entry signal, and has 6 consecutive days below zero for a Woody's trend change to down last week. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 1 week ago, while the daily CCI 20 began a Woody's downtrend last week. Having begun a Woody's uptrend 1 week ago, the CCI 20 weekly fell last week to a positive 15.23 from a positive 34.51 and continues within the plus or minus 50 range for a valid zero-line reject long entry signal if the market rises next week. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: gold and REITs on top, tech and brokers on the bottom. Bullish, REITs and S&P retail have entered the top 5. Oil and oil services have left the top 5. Bearish, computer hardware and disk drives have re-entered the bottom 5. Semis and brokers have entered the bottom 5. Gold and silver continues in the top 5. Focus this week from www.davidstockmanscontracorner.com. Trumped: Why It Happened and What Comes Next, Part 3, The Jobs Deal, by David Stockman. We believe this article contains a very possible financial roadmap for the near future. The following are some key points. As we demonstrated in Part 1, what's winning is Washington, Wall Street, and the bi-coastal elites. The latter prosper from finance, the LA and SF branches of entertainment, movies, TV, and social media respectively, and the great rackets of the imperial city, including the military-industrial surveillance complex, the health and education cartels, the plaintiffs and patent bar, the tax loophole farmers, and the endless lesser K Street racketeers. But most of America's vast flyover zone has been left behind. Thus, the bottom 90% of families have no more real net worth today than they had 30 years ago, and earn lower real household incomes and wages than they did 25 years ago. Greenspan made a giant policy mistake 25 years ago that has left Main Street households buried in debt and stranded with a simultaneous plague of stagnant real incomes and uncompetitively high nominal wages. It happened because at the time that Mr. Deng launched China's great mercantilist export machine during the early 1990s, Alan Greenspan was more interested in being the toast of Washington than he was in adhering to his lifelong convictions about the requisites of sound money. This drastic betrayal and error resulted in a lethal cocktail of free trade and what amounted to free money. It resulted in the hollowing out of the American economy because it prevented American capitalism from adjusting to the tsunami of cheap manufacturers coming out of China and its East Asian supply chain. The truth is, sound money would have led to falling consumer prices, high interest rates, and an upsurge of household savings in response to strong rewards for deferring current consumption. From that enhanced flow of honest domestic savings, the supply side of the American economy could have been rebuilt with capital and technology designed to shrink costs and catalyze productivity. Needless to say, the clock cannot be turned back, and a resort to Keynes's out-and-out protectionism in the context of an economy that suckles on nearly $3 trillion of annual goods and services imports is a non-starter. It would wreak havoc beyond imagination. But it is not too late to attempt the second best in the face of the giant historical detour from sound money that has soured the practice of free trade. To wit, public policy can undo some of the damage by sharply lowering the nominal price of domestic wages and salaries in order to reduce the cost wedge versus the rest of the world. The single greatest things that could be done to shrink the Greenspan-fed nominal wage wedge, therefore, is to rapidly phase out all federal payroll taxes and thereby dramatically improve the terms of U.S. labor trade with China and the rest of the EM world. Given that the nation's total wage bill, including benefit costs, is about $10 trillion, elimination of federal payroll taxes would amount to an 11% cut in the cost of U.S. labor. On the one hand, such a bold move would dramatically elevate mainstream take-home pay owing to the fact that half of the payroll tax levy is extracted from worker pay packets in advance. In the case of a Rust Belt industrial worker making $25 per hour, for example, it would amount to an additional $4,000 per year in take-home pay. Needless to say, You don't have to be a believer in supply-side miracles to agree that nearly $1 trillion tax cut on American business from the elimination of payroll and corporate income taxes would amount to the mother of all job stimulus programs. Thank you for tuning in for this week's Pirls Stock Market Commentary, featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart, compiled by Donald Pirls, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant Mother's Day weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.